I believe we are at the cusp of one of the greatest opportunities in the hands of the people who are patient and long term. Therefore, wish you a great Diwali and a phenomenal.
Under Bharat Bhai's leadership, ASK is today one of the top investment managers in the PMS space. So welcome Bharat Bhai and thank you for being with us today.
Thank you. Very, very, very kind of you to make those generous remarks.
So Bharat Bhai, it's surprising that we meet when the markets are going through some kind of correction or some kind of doldrums, because last time we met in April, you're in the second phase, and I still remember what you had told us. The portfolio is like a garden. You have to, flower the roses and cut the weeds. So, we are again at that juncture where the market is probably in its self-correcting mechanism, cutting out the weeds, or maybe not. So, the first question that we begin, or, the overall theme of the month or the theme of that this video is how fund managers help create wealth. And with that accord, the first question that I will put to you is, with Nifty at 18,000, what is your investment strategy now? And how do you look at the market differently? Or, what is your point of view when you look at the market at, where the headline index is at 80,000 K? And what are you planning to do, or, what are things that you are ignoring? What do you, Bharat Bhai?
Yeah, first and foremost, investment thinking, investment strategy is not contextual to the Nifty level or an index level. It's not as if at some index you have one kind of thinking and philosophy, and at some other level of index you have another kind of a philosophy. That would actually be a sacrilege. And philosophy is not something which is a convenient tool to have, or tomorrow fundamentally continues to find worthy businesses, which are very few, because of the thousands of businesses which are around, only a few are worthy, which deserve your attention, which deserve your money. But before they deserve your money, they first deserve your attention. So very, very few deserve your attention. Most deserve not to be looked at and to be ignored, so that you conserve your energy and you save your time for the ones which are more worthy and which not only deserve your attention, hopefully some of them will find a place in your portfolios. Uh, and therefore, very, very few businesses really have a character to create value of a meaningful variety, of a durable variety, of a predictable variety. Secondly, even if you get those businesses, not always necessarily they are backed by people, the managements whom you can rely upon, either in terms of their competence or in terms of their governance or behavioral pattern. Even if both of those are in place, at times their capital allocation thinking, their capital distribution thinking may be suboptimal, and that may result into a damage to the value creation process. Also, it is one thing to philosophize and think about the business as to what it will do, but it is important that the managements and the management team have the fire in the belly to execute that vision and to convert it into an actual outcome. Therefore, the important second idea is to find the right kind of management, which is all these attributes and more, so that you believe that the potential of the business to create value is actually going to be harnessed by capability, fire in the belly, the integrity, and the behavioral pattern of the management to convert it into an actual outcome. Third, you still need another catalyst, which is growth. Because without growth, no matter how good the business otherwise is in terms of the character, no matter how good the management is in terms of both ability and character. But without growth, businesses don't really remain meaningful investments. They become fixed deposits, and if the growth gets stalled longer, then they actually become kind of a reducing or a negative bonds. And therefore, growth is vital. Now, there are two major catalysts of the growth as an outcome that you decide. One catalyst is the size of opportunity, and the other catalyst is the management character and the intensity and the fire in the belly to convert that size of opportunity into an outcome. The size of opportunity is vital because it requires you to reflect into the future. Size is a matter of statement of fact because size yesterday or size today is more a number and a mathematics, and to that extent, it's a certainty. Size of opportunity is a conjecture, and it is not about yesterday or today, it is about tomorrow. And to that extent, there are many nuances which go into making a meaningful judgment about the size of opportunity. That coupled with an already well-made judgment about the character and capability of management really is the springboard for putting that element of the growth. Again, more than just the quantum of growth, it is its certainty, it is durability, its predictability, which is attributes often are as important and at times more important than just the rate of growth. And therefore, all of these aspects, when you are conjecturing the future, are relevant and important. Finally, you kind of mix up into all of these the quality of the growth. The quality of growth is again very, very critical. And importantly, over long run, most of the investment outcomes are far more beholden to the quality of growth rather than just the brute growth in itself. While growth is essential, but it's not adequate in itself till it is supported by the quality of growth, which in simple terms is ability of a business to lubricate growth in an efficient way, which means you don't need the brute power of the factors supporting growth more and more and more just to get a given growth as an outcome, or it requires less of it to achieve the same growth as an outcome as before. Therefore, ability to do more with the same amount of capital or needing to need less capital to get the same outcome, in some sense, is the description of the character and the quality of growth. It is this which is very important aspect, which makes relatively the friction of producing high and high growth on a larger base relatively smoother and more possible. Therefore, quality of growth in some sense actually makes growth as a possibility to happen. And without the quality of growth, growth as a possibility itself is at a risk. Therefore, quality of growth is a very vital dimension. Once you put all of these into the place, the judgment about the character of the business, judgment about management and the promoter quality, judgment about size of opportunity, the kind of earnings growth, the other characteristics surrounding that growth, and vitally the character, the quality of the growth. Once all these ingredients are mixed up together in the hands of a good chef or a good investor, these ingredients yield to a recipe or an outcome which is like a value of a business. Again, value of a business is not a mathematical number. It's not some certainty like a gospel truth. It's a conjecture. It's an opinion. And therefore, it is a range rather than a number. But in the hands of a good chef, the same ingredients will yield into a nicer recipe. In the hands of an experienced investor, insightful investor, a hardworking investor, many of these ingredients will eventually yield to become a better and sounder judgment of the value. This is critical part because this is kind of a finale and culmination of the all the preceding efforts. Once you reach that point, then I think the inner character of the investor takes over things. All these other parts were more in the realm of intellect, in terms of capability of the investor. Now, thereafter, and then onwards, it is more the temperament, the skill, the character of the investor himself. In terms of making sound and equally refined, progressively better and better judgments of the value. Secondly, and even more importantly, to stick to what is to be done after judging that value, which is basically to ensure that you remain within the boundaries of the right kind of businesses rather than flirt with the inferior ones. And secondly, you not only do that, you buy them with a margin of safety so that you have an additional element working in your favor, because growth in future is one dimension which works in your favor as an investor. Quality of growth is a second dimension. Third factor that works in your favor is the margin of safety, and therefore you want to get that advantage as well. And the final part, which comes from the investor's mind and within, is a sense of tranquility, serenity to deal with the violence and ups and downs of the market without getting impacted and derailed because of that market volatility. And very importantly, wisdom to realize difference between price violence and volatility and change in the character and the value of the business, and to pay attention to the later rather than noise of the former, and to keep doing it all the time, not just one time. And therefore, all that goes before really the intellect and the skill all throw light on what is the right thing to be done. Wisdom actually lets that right thing to happen, not just at one point of time, but throughout the journey. It is this which is philosophically vital. Bottom up stock picking, finding a few limited good businesses which deserve your attention and more analysis, and eventually fewer to find part in the portfolio. And that judgment not to be done once and forever, but refinement of the judgment of the value all the time. Therefore, agility, alacrity, without really falling prey to the violence of the market or succumbing to the honey trap that the markets lay out before you. Therefore, you have a duality to counter. On one end, you need to be confident about your judgment because that allows you to fight with the market machinations. At the same time, you also have to you have to realize that your judgment may have infirmity or a weakness, and markets may be throwing the signal which may need to be listened to, and therefore you need to have faith in your own conviction, but you need to have doubt about whether it is all completely correct or it needs a revision. You need to have confidence and you need to have diffidence. You need to have trust and you need to have skepticism. It is mixing all of these and putting it all together, which is at the foundation of all that you eventually do. That's a foundation of the wisdom. Therefore, really speaking, bottom up stock picking, finding a few quality businesses, few great managements, judge their value, their future, keep revising these opinions, stick with discipline to the limited few quality franchises, Keep evaluating the mathematics of that investing in terms of margin of safety, and do not get carried away by short-term attenuation or the machinations of the market, but remain steadfast on the long-term journey and remaining on the wise path. That I think is investing. That is what is the philosophy, whether yesterday, whether today, and tomorrow, whether the index is 8,000 or a 10,000 or 15,000 or 20,000, or tomorrow Nifty is 30,000. I don't think philosophy needs any change.
Right. Thank you, Bharat Bhai. That was very elaborate. And I can tell you one thing, Bharat Bhai, is that we've been interacting for the last 2 years at PMSF World, and I've been following you for a very longer period than that. It is your conviction and it is your entire approach about management, about growth, and the trinity of management, growth, and probably persistence as an investor. Like you said, a good investor harnesses all the power of a good company or a good business over a longer period of time. So this is exactly what we have been discussing for a while, how fund managers add value. So do you think that this comes to you more naturally as a process of doing this occasionally for the last 30 years or so, and someone for a lack of better word, newer to the stock markets or newer to the nuances of investing, might not get as easily. What are your thoughts on that, sir?
But that's a very incisive, very profound question that you are actually raising. Uh, there are some parts of the investing which you can learn and which you can refine and which you can improve upon over a period of time. So there are parts of it which are skills which can be polished up, which can be improved upon, and which can be made better over a period of time. Uh, then there are other traits and attributes as an investor, which over a period of time I have come to realize is some of those traits are actually hardwired. They are not they are not very easy ways of acquiring. In some sense, uh, some of those traits you may have it, or some of those traits, if you do not have, then it is very, very difficult to practice good investing thereafter. And I don't want to sound fatalistic about that later part, but genuinely over a period of time, I've come to realize that there are things that somewhere has to be part of your core DNA. Somewhere it has got to be part of your core thinking. And if it is not very deeply seated in your psyche, then it becomes very difficult for you to deal with the market behavior. Now, what are the former part and what are the later part? I think the science of investing is something that belongs to the former part, and the art of investing, in my opinion, falls more into the later part. Therefore, science of investing in terms of understanding the character of business, in terms of systematically developing an approach to understand the character and capability of management, trying to gain a better insight, better understanding of what are the notions of the size of opportunity. How does all that correlate into possibility of growth into future? The concept of economic life of the business rather than physical life of the business or physical life of the assets is distinguished from the real economic life of the business to be able to create value. And the basic mathematics of the investing in terms of judging then the future in terms of the likely outcome, a range of outcome, discounting them to the present, making an opinion, refining that opinion, and keep doing that again and again. Many of these parts happen to fall into the science of investing. And while even in the science of investing, there are critical capabilities which you need to have a reasonable degree of a kind of a talent for. But it can be improvised, it can be refined, it can be materially be made sharper over a period of time as you are focused on it and as you are determined to get the best out of that for yourself and therefore for your clients by continuing to focus on that investing well. Therefore, many of these parts of the science of investing, Sankalpo, I can't see your face and it becomes a little difficult to correlate without seeing somebody on the screen.
So
Uh,
sorry. There's some
yeah,
network problem. So
yeah,
on
no
and off.
worry. No, no worry. So, the first part, the science part, while that also calls for some fundamental certain skills, certain capabilities, certain talent, but many of these can be improved upon, can be made better, and can be refined. It is the art part where I think a greater part of the challenge lies. And I suspect, I believe some of these art part of the capabilities are something that you are materially hardwired with. Either you have it or you do not have it adequately, and it's not very easy to materially improve it if you don't have it. And therefore, that is a part which becomes a significant part of a challenge. Now, one is, for example, what I talked a little while back, that how investing requires you to carry two contrasting emotions simultaneously in your head at the same time. You need to have a trust, but you need to doubt. You need to have a faith, yet you need to have skepticism. You need to have conviction, yet at the same time, you need to have worries. And it is only an ability to carry both together in your head, a contrasting emotions, and yet making sense out of it. Uh, that's not a very easy skill to, easy trait to have. And not intellect is not a substitute for having that trait. I mean, either you are able to have it or it is a bit of a tough luck if you can't really bring that about. Second is countering emotionality of the market with your own rationality. Now, that's a very important duality again that you need to have. Markets will be emotional all the time. It will always be a mixture of rationality and emotionality at any point of time. It's only the extent of rationality and extent of emotionality in the mix may vary at different points of time. But markets always will be a mix of the two. And the only way you have an advantage over the market, or you can hope to have an advantage over the market, is to counter the emotionality with the rationality. And again, that is difficult. When the markets play the tricks, both on the upside or on the downside, intellect is not a good way to counter that what unfolds in the market. It is the trait within, the capability to calmly respond to the emotionality of the market with rationality is a very important trait to have. Without that, it is not so easy to really deal with the violence of the markets. The third is to recognize our own limitation. Because as investors, there is only so much we know. There is only so much we can hope to know. And we always have to realize that there is so much more to know, and that we cannot conceivably hope to know everything. However hardworking, however bright, however methodical we may be about it, but there is not everything that we can hope to know at any point of time. There will always be something that we may have missed, we may not have fully comprehended, we may not have fully applied our mind to. To recognize our own limitation, to recognize our own fragility, and recognize our own, so to say, weakness is one of the most important strengths to have in the investing. To recognize your own investing, to recognize your own weakness is one of the greatest strengths to have in investing. Because without the support of self awareness, you cannot really hope to deal with the markets in an efficient way. And I would say it a recognition of your own limitation is an ultimate act of wisdom. Again, intellect is not a substitute for that. It is some of these which are really some significant sources of the strength that you bring to bear on the situation, which equips you to deal with the investing situations and its volatility, its violence at times, its attempts to seduce you. At other times, its attempts to really make you a psychotic, depressed individual. Many of the frailties and many of the enchantments, how do you kind of walk your path through and to recognize that there are not 100 ways of arriving at the truth in investing? Though often enough people say that there are this also is a way, and that also is a way, and third also is a way, and fourth also is a way. Really speaking, not. There is only a limited path, that path is a twisting and turning path. It's a tortuous path, and it's not an 8-lane highway. It is a very narrow, tortuous, winding, constantly upward, downward, sloping kind of a curve. And therefore, you need to navigate your vehicle through that path in a very careful way. It's not as if there are 10 ways of achieving that. And recognizing all of these, I think, is one of the most important sources of advantage that you carry as an investor. So, intellect takes you only up to a point, but I think your discipline, your character, and your temperament and your wisdom, these are far greater armor, far greater weapons to have in your army.
I absolutely agree with you, Bharat there. And as an investor, as an individual investor, like you said, I have been seduced, I have been psychotic, I have also been rewarded by the markets. That brings me to my next question, and it is in continuation of what we were discussing, how fund managers add value. Okay, so like you said, a lot of it is probably intellect, but then but equal amounts are, things like temperament, things like discipline. Okay, so what we have often seen is India has been a fantastic land, fantastic country in terms of opportunities. And I remember in your words only, you still feel like a kid in a candy land in the Indian markets. So there are a lot of opportunities around there. Okay, and the successes in equity markets like Asian Paints or probably Bajaj Finance, that have been there. So most people are guilty of, or most people couldn't write the entire journey. They came out even before the entire story played out, or for that matter, the earnings got to full potential. But I know for a fact, you as a fund manager or your team as money managers have been with most of these businesses for a seriously long amount of time, or you probably still hold them. So how is it that for these common companies, everybody knows about these companies, that there are such vast differences in the opinions, such vast differences in the holding periods, and and ultimately the ones that are rewarded are obviously the ones that stay, how does this difference in behavior according to you arise, and how do you how are you so confident, and what is that factor which makes you more confident than others to stay the course?
No, again, a very, very, very important question you're asking. Very something which
Bharat
is
bhai, just before that, let me give a disclaimer. These are not advices. These are just for educational purposes. So please construe them as such, and please consult your financial advisor before you buy any of these stocks. Over to you, Bharat bhai.
yeah. So as I was saying, I think again a very pertinent and very important question that you are raising. But before I answer that, the kid in the candy shop is not my quote. I have borrowed it from Buffett, the redoubtable, venerated Buffett, and I've merely been I've been a beneficiary of using that as a very nice, foxy humor that Buffett is so well known for. But I do believe we are really spoiled for choices if we think about it in the next 20 years, and I'll say next 20 years, not just next 2 or 3 years or 5 years, but or even a decade, which 3 years back I wrote about a golden decade ahead for India. But I would today, I'm more tempted to say 2 golden decades ahead of us. So it is really, in some sense, the kid in the candy shop kind of an opportunity before economy, before good businesses, good entrepreneurs to create value, and of course, in the hands of disciplined investors to create outsized value over the next couple of decades and more. The fundamentally to answer that on the names and the well-known businesses, differing opinions, differing behavior, differing holding periods, and when people cannot hold for long enough and they come out early, if I'm permitted to make a little crude remark, this is equivalent of premature ejaculation. And premature ejaculation doesn't lead to the most satisfactory outcomes or the kind of a culmination of what you would have probably hoped to get as an experience after that. I think in a much larger way, in a much more fundamental way, I think investing is about the staying power. It is discipline to stay the course and to be on the path on a long run. That is even more important than the all the knowledge, all the ability to pick and choose businesses, identify some of the most winning opportunities. While those are important in themselves, but they are not enough. And I would say ability to hold something worthy for a long period of time is an ability, is even a bigger contribution to make than a merely ability to pick and choose wisely or at a right price or ability to judge value well. While all of those are very important, ability to stay the course is a pinnacle, is a culmination of that. And it's not easy. It's never simple. I mean, if you look at Bajaj Finance, for example, over 11 years or so, a rupee put into Bajaj Finance is turned into more than 100 times. But it's not a straight line upward sloping curve. Rupee might have at some stage become 3 rupees and 4 rupees or 5 rupees before being pulled back to 3 rupees and 3.5 rupees. From 3.5, it may have gone to 8 rupees and 10 rupees before falling down to 6 rupees and 7 rupees. That 7 rupee may have gone up to 20 rupee before falling down to 12 rupees and 13 rupee, and then so on and so forth. Therefore, there are, even in the best of the businesses, even in the greatest value creation stories, You go through long and many different periods of tortuous existence. The moments and the phases when your beliefs are tested, your confidence about owning those positions is tested, the fact that rationality at that time may succumb to emotionality is something that gravitational force of emotionality, how well you have been able to counter is very, very vital. And many of these issues have, once again, I am repeating, have nothing too much to do with the intellect or knowledge. It has far more to do with the person that you are, the temperament that you have, the wisdom to know that what is transient and what is durable. How do you distinguish between the two? An inability to distinguish between what is transient and what is relatively more permanent is one of the biggest failures that you can have in investing. And intellect doesn't have neither a complete answer or not even an adequate answer for that. And therefore, while you need to choose good businesses, you need to choose good managements, you need to have hardworking model to keep revising your understanding all the time rather than just make one sound decision at one point of time. Your ability to make many of the factors that will eventually culminate into the judgment of value, you again and again examine, re-examine, suffer from doubt, suffer from confidence, suffer from worries, but eventually keep revising and judging what you have been holding to see whether the arithmetic of investing or the logic of investing continues to stay the course. While all of these are important, it is the later part to stay the game, to not fall for the machinations of the market, to honor and respect the duality of investing, to recognize the greater role of wisdom rather than that knowledge, and to recognize one's own frailties, one's own weaknesses. Many of these are far bigger sources of finality of the outcome that happens. And one final point I'll make there is we have to recognize that compounding is a huge, huge power. And as the period elongates, the power of compounding works disproportionately ferociously. Therefore, a 25% compounded for 3 years is doubling, but that done for 6 years is quadrupling, and that done for 9 years is actually eight
Yes.
times, and that done for 12 years is actually 16 times. And as you recognize that what becomes 1 rupee to say 80 rupees or 100, you miss out 1 or 2 years out of that journey, then 1 rupee becoming 100 may actually end up becoming more like 40 and 50. Therefore, cost that you pay for flirtation, cost that you pay for slip ups, cost that you pay for violation of discipline, and the cost that you pay for temptations or the inability to subjugate emotionality by rationality. The cost is real, it is not notional. The cost that you pay because of that compounding nature of investing. It is the later period, small period makes a disproportionate impact on the final outcome. It is this which is actually very, very important. And final point, markets are never short of intellect because typically financial markets attract very bright people. By and large, people who are talented, people who are bright, people in general who have good IQ. Uh, if they are suboptimal or the inferior IQ, in all probability, markets are too ruthless to let them survive for too long. While that is a necessity that you need to have a reasonable capability, not a Einsteinian kind of intellect is what I'm talking of, not a Newtonian kind of intellect, but reasonable graces, reasonable enough intellect. But markets are like a centrifugal force. If you do not have that basic capability, then markets will throw you out. But that intellect is never in short supply in markets. It is the other part, the art part. It is not the science part which is in short supply. It is the art part which, more often than not, is in a relatively far greater degree of shorter supply. But that is the part which makes a disproportionate impact on the final outcome. Therefore, science plus art is equal to the final gratifying outcome. But art as an equation is greater and rather meaningfully greater than science. Third, the duration, the later period duration has a disproportionate impact on the overall outcome and the finality of outcome. And therefore, it is that art part. And as I referred to it earlier, the art part is relatively more hardwired and probably part of your DNA, at least in a substantial way. And therefore, uh, reasonable deficiency in that will make outcomes very ordinary or suboptimal compared to the outcomes which are otherwise possible based on that knowledge and ability.
That's very profound, Bharat Bhai. And I like how you have been focusing on two distinct skill sets, or rather, two distinct kind of necessities as an investor: the science part of it and the art part of it. So, that that kind of makes me think a lot of people eventually do acquire the science part, because if it's a skill, it can more often than not be acquired. But there are, of course, people who are better at it, inborn as a talent. So, in terms of the temperament part now, okay. So, temperament is for someone to develop. It is something you can hardly acquire. This is something that you probably practice for a very very long period of time, or something that you might be more learning through mistakes, or learning through costly mistakes that too. So the market today is divided, like people talk about science and art in the investments. People also talk about consistency or alpha. More often than not, they can come together also. Like alpha can be consistent, and but a lot of focus, this industry, fund managers or even investors are very alpha driven. The questions, a couple of quarter of alpha drop, or a couple of quarter where there is underperformance, the fund manager is often chastised. I'm not saying that rightly or wrongly. That's for the investor to ultimately decide. But what's for how do you look at alpha and consistency? Would you rather have alpha throughout, even if it is at a lower number, or would you rather be consistent in your performance over longer periods of time?
Yeah, okay. Uh, no, again, an important issue. First and foremost, I would say, unfortunately, many of the investment organizations where people who have to opine on how managers have acted and how they have behaved themselves more often than not may not have necessary framework or a mindset or enough of an understanding to make right judgment on behavioral pattern of the managers. Secondly, why does that happen? Because world more easily sees price because it's a tangible number. But world finds it harder to correlate to something which sounds more amorphous, which is like value. Similarly, even within the investment organizations or others, like at times clients or other observers who have to opine on the behavior of the managers as to how well they've done, More often than not, for them, the tangibility of a return at a point of time appears more certain. But the process and methodology which will ensure the returns itself in future is something which is amorphous from their point of view or something intangible. Much like that, returns is sound like price. Returns sound definite at a particular point of time for a particular period compared to some index, compared to peer set. They sound concrete data, and therefore that's how the evaluations and judgments are made. But risk control, which is as important, if not more, than the returns earned at a point of time, that risk control is even more important, in my opinion. But that's harder to judge, harder to comprehend, harder to evaluate. And most of the people who have to opine or judge or evaluate have a shorter term frame of picture in mind, while investing is all about long term. And therefore, these particular set of factors unfortunately may result in chastisement, the word that you use for managers who in a short period may or may not have performed, even if they've done the right thing on the longer term. That is because those who have to opine on it or judge it are not always in a best position to make that judgment themselves. And therefore, that causes the contradiction or contradistinction in that. So this is unfortunate. Why it is so unfortunate? Because it perpetuates certain kind of stereotypes. Because what is more tangible is recognized, it forces people to take that as a benchmark of behavior and forces them to move them closer to that with a belief and a hope that that is how they'll be able to get longer term sustained superiority of outcomes. And therefore, it results in accentuation of a trend in a certain direction, a behavior perpetuation in a certain way. And therefore, independence of the mind and ability to take a view which may not be consensus view becomes very difficult for managers to take when shorter term biases are fundamental core based on which they are going to be judged. And therefore, even good managers and capable managers who otherwise have a right sense of control over their destiny and what they have to do may unfortunately be put to kind of pressures which may not be sensible and in the interest of neither the organization nor in the interest of the clients. Therefore, what you are saying is again a very, very important fundamental point, because it is these attempts to measure the short term in a concrete way. When I say concrete in a more quote unquote kind of parenthesis, it perpetuates a commoditization of behavior. It accentuates trend in a certain direction in which it is flowing. And therefore, fundamentally investing, which requires ability to take when needed and when intelligent to do so, non-consensus view or an independent view, it it may actually discourage and may force another kind of behavior on the other side of the equation. So that's one. Second, you talked about alpha and consistency. But again, they are not antonyms and they are not two polar opposites. In fact, the only way you are likely to have an alpha over a period of time is by having a consistency of approach, a consistency of thinking, a consistency of a philosophy. And of course, that philosophy and approach all have to be founded on a right foundation. Then only you need to be long term, but pebbles stored for long term don't become diamonds, and therefore philosophy and approach and consistency is vital, but that philosophy and approach fundamentally has to be the right one. So assuming that the consistency is right, consistency of philosophy and approach and stock selection and portfolio construction methodology all are in a right shape, then that itself is a necessary causal factor which is at the core of creating an alpha over a period of time. The confusion comes when you are seeking alpha every month or every quarter or every half year or even every year. That is where the confusion comes about. But it's not as if that you can have one or the other without having consistency of a good approach and a good philosophy. It is impossible to even aspire to have any alpha. And alpha is a worthy goal. Ultimately, an investor fights the battle in order to create a better value. If it based over a period of time you can match what index is doing, then there is no case for an active investing. And to that extent, it is better that that money goes into the hands of passives, because at least the index will provide, if you believe that index will reflect economic conditions and economic outcome, then reasonably you can make a judgment of what kind of outcome on a long run may happen. And in a country like India, for example, high single digit or double digit kind of index compounding over meaningfully long period, let's say next 10 or 20 years, is a reasonably clear possibility. But a good manager, an investor who really wants to fight that battle and puts his wits into the contest, puts his head into the ring, has to aim to defeat and get something better than that index has written. Otherwise, his own very raison d'etre or the reason for the existence is not really there. Therefore, any investor over a period of time has to aim for an alpha and has to aim for some kind of an additionality to be brought about on the table rather than just the index. But it is not as if consistency and that alpha are two polar opposites. Without that consistency of a good approach, that alpha itself will be at a peril and at a risk. So it's a cause and effect, and it is not one or the other.
Right. Understood. So, Bharat bhai, you raised a very important question then. How, what is your advice of investors to evaluate their fund managers or their money managers? If you can quickly tell us that, what can be the right metric? I am assuming if the input is a little bit of art and science, the output also should be, even though it's very empirical, should be taken or should be evaluated with a bit of art and a bit of science. So, what is your advice to investors on how to measure the performance?
No, clearly, over a meaningful period of time, numbers have to speak themselves. Numbers can't
Right.
lie over a meaningful period of time. It is the confusion that is created when numbers are measured for very short periods of time. Over a meaningful period of time, both the risk and returns, both the solidity or otherwise of the approach and selection will all come into the play.
That's very clear then. So investors need to focus over longer periods of time. I think the science part of it should be, or the investment success can be reasonably measured by empirical numbers. So Bharat bhai, the last question for this episode or this interaction is, we've spoken about so many things, and a lot of them were behavioral. And now we will come to what investing ultimately gets to, building a portfolio. So how does your investment process or your philosophy overall, you know, let's say, ignores the noise? Because I know for a matter of fact you've chosen the right business, and that is why the performance has come. So how have you built your process, or what is your advice to investors and fund managers, who look up to you to probably effectively ignore noise, which which will then take care a lot of other behavioral traits.
Well, again, all the core questions you are raising, Sankalpo, and uh, one of the key critical capabilities of any meaningful investment track record and any good investor is ability to tame the noise and let the signal flower. That is one of the most predominantly vital qualities and attributes, which is what I was alluding to earlier, that how do you counter the emotionality of the markets with the rationality of the mind? And if you allow emotionality of the market also to become emotionality of the mind, then the two together don't do a tango, they create an orgy. And there is a trouble there. And therefore, you need to counter the emotionality of the market with the rationality of your mind. And that is one important source of creating an alpha over a period of time. Otherwise, markets can make a mincemeat out of you. Therefore, the fundamentally fundamentally ignoring noise is one of the most important empowerment and self nourishment that a good investor can do to himself or herself. Now, how do you kind of subjugate noise, or how do you kind of tame the noise? Eliminating is a very ambitious target, but subjugating, I think, is a more meaningful
Exactly.
objective to have. Well, again, the yin and yang, there are two parts to that, I would say. One is your own personality, and second is your efforts and understanding. Ultimately, over a period of time, enough information, enough data, and reasonable intellect and purposive effort, they all convert into knowledge. If you are intense about what you do, you're passionate about what you do, you have reasonable intellect to be able to do that well, then large pieces of information and data that you acquired, and which is important in investing, because there are many pieces of information that you store in your mind over a period of time that eventually becomes knowledge. In the initial phase, a lot of that looks like data chunks and data breaks without making coherent sense. So you have maze of data, but they don't all connect together and they don't become a coherent piece. They don't combine into a coherent whole. And it requires a long period of time, efforts, intensity, purposiveness for something like that to convert into a good outcome over a period of time, in form of better and sharper and greater knowledge. Now, as you acquire greater understanding, as you acquire greater knowledge and the real understanding of what you are doing in terms of the character of the business, what is likely to make it valuable and what can take against it, trying to make meaningful judgments and observing it over a period of time. What are the traits of a good management, and how do you identify that? How do you identify signs of a business which is potential to display large size of opportunity? How it will translate into growth, and then other connotations of the qualitative connotations of the growth. All these are pieces of knowledge that you acquire over a period of time. In the initial phase of many years, it's frustrating because you are acquiring data and information, but it is not converted into knowledge. Therefore, it is that phase where a hard work is lot of hard work goes, and output looks underwhelming from your perspective because you work very hard, but outcomes appear to be limited. And instead of verticality, you have a reduced or negative horizontality in that phase. Then comes a point of time when the two walk together, where you start beginning to feel that as you are putting more effort, you are learning as much. And there comes a phase thereafter where verticality takes off, where actually less amount of effort produces far greater and far more productive, far more fecund outcomes at that stage. That's where the joy and the power of investing becomes far more palpable, far more evident, far more in your favor. This is one part, that knowledge, that effort, that reasonable intellect that makes it all happen, all these, when they combine, eventually culminating into knowledge, helps you in keeping your mind more confident and not making it fall prey to the signals, or rather to the noise that a
Uh,
market may be throwing at you.
right.
Market in a perfectly good business, which should go up, may make it go down. And equally, markets may at a point of time, a perfectly rubbish business to make it look like different and make it go up. It is at these points of time, and when the departures are not merely deviation, but sharp departures from where they need to be, that's where knowledge gives you confidence. Confidence gives you equanimity, and that equanimity allows you to ignore the noise and listen to the signal. The second part is again something that you represent your personality, your own character, your own mind. That how do you realize that in life, very, very few things really are worthy, and most things are transient and temporary and relatively peccadillos, insignificant, and not really critical. It is to recognize the power of wisdom over the power of knowledge, or to recognize the power of wisdom over the power of intellect. It is recognition of one's own frailties and one's own weaknesses, which gives you real strength to learn to, kind of subjugate and tame the noise. Doesn't mean that you reach a nirvana. None of us is a Buddha, and none of us has equanimity and the calmness of that middle path that Buddha advocated to be able to carry in our head all the time. So, time to time, even however good we may be, we still feel troubled by the market behavior, and we unduly get excited by the market behavior, however recognizant we may be of these behavioral patterns of the market. But it is it is not that perfect wisdom of the Buddha that is possible or even necessary, but it is enough of it to be able to really, by and large, be able to listen to the signal only, and by and large, able to, kind of ignore the noise. This is like when you are sitting beside a very large, powerful ocean. When the waves are coming with a power and they make a lot of rumbling kind of a noise. And when the waves are receding, the noise is kind of reducing. But if you really recognize the pattern of that ocean's behavior and actually you have acclimatized yourselves to it and have come to understand and believe it, really speaking, that even the large rumbling noise of the ocean doesn't even register in your head. In fact, it becomes like a very pleasant symphony playing in the background rather than a cacophony. It may be noise, but that noise becomes like a symphony in your head because you realize the rhythmic pattern of it. It's invariable, nice kind of a cyclicality of it, which falls into a pattern, and it stops being a distraction or a noise, but it becomes actually a harmony and a symphony in your head. So much so that when you are sitting beside it with the large amount of noise that the ocean waves may be making, you actually may accomplish something which requires the highest degree of focus and concentration because it sounds like a signal. On the other hand, when the mind is not able to recognize that, even a small amount of kind of like those audiometric tests which are played out, that little small sound in the background, which may not be enough to derail you, but it can disturb you and can completely take your focus away from what is really the signal, and can take you towards the direction of that noise. Therefore, both what you do with your methods and information and convert it into knowledge, and how you make your mind more serene, more calm, recognize your own weakness, and recognize the power of the opportunity that the signals may be throwing at you. It is again the duality of that which allows you to subjugate, not eliminate the noise.
Right. So if I'm getting, if I'm understood correctly, I mean, ignoring noise is a matter of a conviction, spending that evolution or evolving stage in the market where, a lot of times your efforts wouldn't have paid you those rewards. But eventually, if you keep on doing the right things, you will realize that, you will have conviction in your methodology. That's very, very profound. And thank you for that, Bharat bhai. I hope the investors on this call take a cue from this and probably implement a lot of it. Thank you, Bharat bhai, for being with us today, and thank
Pleasure
you for
always.
your. Yeah,
Pleasure
you were
always
saying.
speaking to you because you ask questions which are not noise but which are signal, and therefore I enjoy talking.
Thank you so much, Bharat bhai, for that compliment, and we look forward to talk to you again.
Okay.
And we wish a happy Diwali to all our listeners, all our investors, and stay safe. And may the lights of the lights of knowledge enlighten your investment journey. Thank you.
A very happy Diwali to you, to Nazneen on the call, and to all viewers. I think we are at a crossroad of one of the greatest economic expansions for this country. And emerging from the shadow of the pandemic, hopefully we have kind of materially left it behind now. Hopefully,
Fingers
uh,
crossed, sir.
fingers crossed. But I believe we are at the cusp of one of the greatest opportunities
Hopefully.
in the hands of the people who are patient and long term. Therefore, wish you a great Diwali and a phenomenal period ahead.
Sir, I just have one personal question, which obviously we won't
Okay.
feature. So, you have seen a lot of investors, you have seen fund managers groom them. Do you think that, it could be a possibility that there is a different personality and a different investment personality? You know what I'm saying? Like the way someone is as an investor is very different from his or her individuality. Like it happens in sports. A batsman can be very, very cool and calm on the crease, The moment he's off to the pavilion, is very aggressive. So, do you think this happens?
No, no. I mean, if an investor is a, Jekyll and Hyde kind of a split personality, that's a very terrible thing that
Yes, sir.
can happen. I I personally believe I not that I can easily establish or prove, but in general, uh, good investors by and large are good human beings as well. That is my really strong belief. It is not mathematically correlated. There is a perfect 1:1 correlation. But I would say there is a material amount of observational merit in that statement that I'm making, in my opinion. Uh, that generally good investors fundamentally tend to be are kind of better human beings, and tend to be better uh, in some core sense people who are curious about life, about world in general, about opportunities. Uh, you see, any good investing journey should make a person wealthy and sufficiently wealthy. It is unlikely that a good investor is likely to die in penury or poverty. Therefore, wealth, riches, all the accolades that you may get, all these are important, but I would say they are byproducts. Ultimately, the joy of walking on the journey of investing, the knowledge that you acquire and you get, the kind of learning that you acquire by doing that, the kind of aspirational delivery that you do for people who trust you for doing that, and the kind of difference you can make to the lives of a lot of people around you in terms of the pursuit is a fantastic both inner as well as outside journey. So to that extent, you know, there can be a terrible athlete as a person. Like we know there are so many boxers in the world we know without naming names, but who are perfectly probably describe the description of horrible individuals if what we know about or what we get to know about them. Even if they are among the champions at the top of that pyramid in that boxing world, or many other branches, football, many other sports, or many other fields, not just sports. But I have my own doubts that Jekyll and Hyde kind of a split personality exists or can even be possible in good investing. That on a personal basis, mm, you are a very volatile individual, but as an investor, you are a very calm person. It is not easily possible. I mean, you can't have that duality or that Jekyll and Hyde kind of split personality possible there. I don't think so.
Thank you so much for that as well, Bharat bhai. So I'll send the video once it's uploaded on YouTube. Thank you, Nazneen, for arranging this. I wish you a very happy Diwali, Bharat bhai and Nazneen. Thank
Yeah,
you.
you too, all of you. Please do send me the
Of course, sir.
recording.
I'll personally send you.
Gee, thank you.
Thank you. Thank
Thank
you.
you.
Thank you, Sankalpo.
Thank you, Nazneen. And thank you,
So
Sankalpo.
I'll see you in office
Thank you, sir.
Yeah.
Monday. Yeah.
You are coming. Okay, fine. Yes,
Okay.
certain.
All right.
Bye.
All right.
Bye.
So then whenever I meet you, happy Diwali to you and ma'am.
Yes,
Thank you.
absolutely. Thank you.